Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is transfer pricing. And here, guys, we are talking about the basic contents of transfer pricing. We have a second video about international transfer pricing, and the video is in our video description. So, what is transfer pricing? Is the determination of an exchange price for intra-organizational transfers of good or service. Division A's, other quotes here, sells sub-assemblies to Division B. Products can be final products sold to outside customers, for instance, batteries for automobiles or intermediate products, components, or sub-assemblies. And transfer of products and service between business units is most common in firms with a high degree of vertical integration. And what are the objectives of transfer pricing? And the same for evaluating performance of profit and investment centers or divisional centers and so on. Motivate managers, provide an incentive for managers, provide a base for fairly rewarding managers. And specific international issues, only to clarify here, minimization of custom charges, minimize income taxes, currency restriction, and so on. 4 models of transfer pricing. We will be working in some minutes with these models in our Excel file. Variable cost, standard or actual, with or without a markup for profit. Full cost with or without a markup for profit. Here the difference between variable and full cost. Variable cost, we don't consider the fixed cost. Full cost, yes. Market price, perhaps reduced by any internal cost savings realized by the selling division. So, okay, I am, under quotes here, purchasing from my division by the same price that I would be purchasing outside. Or negotiate the prices between buyer and selling units. I'm choosing which one is the best one. Firms can use 2 or more methods, call it dual pricing, one method for buying and a different one for the selling units. There are 3 considerations here to choose the best one. Is there an outside supplier? If yes, we can compare it with a market price. If no, is the seller variable cost less than the market price? Is the selling unit operating at full capacity? And so on. So here are some advantages and limitations of the 4 methods. Advantage, relatively low transfer price incurs by internally the correct decision from the overall firm's standpoint. Limitation, unfair to the seller unit because the price will not be considered their fixed costs. Full cost, easy to implement, data already exists for financial reporting purpose. We will go on that for the journal entry of this transfer price. Intuitive and easily understood, preferred by tax authorities over variable cost. Remember, guys, for tax, we cannot use variable costing. We need to use full cost or absorption costing. So for tax, full cost is the best one. Limitation, the same limitations of the absorption cost. Irrelevance of fixed cost in short-term decision making. Fixed cost should be ignored in the buyer's choice and so on. And if used, it should be standard rather than actual cost, but most companies use the actual cost. Market advantage helps preserve subunit autonomy. Okay, instead of selling this component to my own company, I can sell it to a third party. So I will be using the same price. Provide for the selling unit to be competitive with outside suppliers. Has arm's length standard desired by international taxing authorities. By the way, it's a very important topic for international transfer price. Remember, the international transfer price video is in our video description. Limitation: often intermediate products have no market price and should be adjusted for cost savings such as reduced selling costs, no commissions, no sales tax in a lot of countries, and so on. And can lead to short-term sub-optimization. And negotiated price, the best one theoretically. Maybe the most practical approach when significant conflict exists is consistent with the theory of decentralization. However, need negotiation rule and or arbitration procedure which can result autonomy and can be a lot of time consuming as well. Potential tax problems because may not be considered at arm's length. And potential sub-optimization, dysfunctional decision. But how do they work? So let's go to our Excel file here. By the way, this Excel file is free, just like all our Excel files on Accounting Hub. And the link to download this Excel file is also in our video description. So, okay, let's consider here. The first one, how to find the transfer price. So let's consider that we are producing the component X. And then we have the variable cost per unit, $80 or 80 any currency. Fixed cost, $350,000 per month or 35 per unit. How do we find this 35? Fixed cost divided by production units. And a market price of $200, and we will be adding a markup here for the seller division, 150%. So, okay, how do we find it? The total cost for variable cost is only the variable cost. The markup, cost times 1 minus the markup. So, whoops. It's the opposite, so sorry. Let's repeat it. Cost times, whoops, times markup minus 1. Okay, perfect. So here the transfer price is 120. What is the change here on full cost? The total cost is the variable plus fixed cost per unit, 115. The markup, cost times markup minus 1. And remember, we don't edit our video, so just like a regular class. So 172.5. The market price would be only 200. So we don't need to go on the cost markups and so on. And negotiated price. So, okay, we are negotiating, and let's assume that we will round up the average of these prices. So here 165. What is the journal entry here? And let's assume that they are at the same company. So it's not a company A that is a subsidiary of company B. They are at the same company. So our debit will be inventory or inventory. And we are doing here the product A. So inventory, product A. Usually the work in process inventory. And credit, inventory, component X. How much? For financial accounting, and here we are talking about financial accounting that we are doing the journal entry, it is the full cost, we don't consider markup, times units. 1,150,000. If they are in different companies, because we also have the cash and so on, we will need to do the unrealized gain on inventory. but that is a topic for consolidation, advanced accounting. So we usually don't go on that topic on cost accounting. So usually for cost accounting, we don't consider the markup. Okay, how would be the financial statement here? So, okay, now we are doing the product A with this selling price, additional variable cost, additional fixed cost, the same 10,000 units because one component X is needed for each product A manufactured. So here we have two income statements, one for the component X, one for product A, and then we will combine the operating income later. So, okay, how much will be the revenue? So revenue will be, and then here we have all of the four methods, variable cost, full cost, market, and negotiated, that is, over there. Or over there here, if we, my camera is on mirror, so over there. So 120 times 10,000 units. Or let's do it better. 120 times 10,000 F4, and we are fixing it. Revenue here, full cost, market price, and negotiated price. Costs, how much will be the costs? So the costs here, it will be only the variable cost because we are working with the variable cost times 10,000 units. For all of the, or here is the variable cost for all of them. So here, 800, variable costs, and okay. Fixed costs, we don't consider them for the variable costs method. So fixed costs, 350 for the remaining two. So here are our methods. What about the product A? Revenue. It will be $300 times production, 10,000. And it will be the same revenue for all of them. And let's move myself here. $3 million. So here, the combined operating income, we have here, costs. How much will be our costs? Our cost will be transferred in. Cost is the revenue of the component X. So here we are, because remember, what is revenue for the seller is the cost of goods sold for the buyer. So here, 1.2, let's copy and paste here. And why do we do here? Because this one matches, whoops, this one here, let's do some blue and white, yellow, green, and blue, the colors of Brazilian flag, my home country. And it will always match with the transferred in cost because the combined operating income will be the same for all of the four methods if we have no inventory, no unrealized gain on inventory. Here we have no inventory because 10,000 components, 10,000 products, one by one, and we have no inventory. Why are they not the same now? Because additional variable cost, 40 times production, 400. Fixed cost, for the variable cost, remember, we don't consider the fixed cost on the transferred in. So the fixed cost will be the fixed cost for the component X, 350, plus fixed cost for the product A, 490. And then for the full cost will be only the additional And here only the additional. So at the very end, the combining operating income will be the same for all of the methods. And so this color here looks like an orange. I don't know. So here the combined operating income, again, if we have no inventory, they will be the same. So here the transfer price is only to measure efficiency across the company or the company and its subsidiaries. The combined for the shareholders, it doesn't matter, it will be the same. So it is for internal control or internal performance only. Okay, guy? Interesting, huh? Interesting and easy. So thank you so much. Questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.